Folks, it's Simon here with your Tao Daily for market close Thursday, the 10th of April 2025. Now, markets were a little bit weaker. Well, actually, they were quite a bit weaker. I mean, a 4.4% drop in the S&P, given that the current situation feels like a fairly modest drop. On any normal day, that would be a fairly catastrophic drop. But given the sheer scale of gains yesterday and the historical precedent for market declines following very large one-day advances, today's decline shouldn't come as a big surprise. That said, the pain that the indices experienced during the day was pretty significant. All right, US equity indices got within spitting distance of circuit breakers as the S&P dropped more than 6% intraday before rebounding to a more modest. Well, if you look at SPY, it was a 4% drop. If you look at SPX, the cash index, it was a 3.5% drop. As a reminder, circuit breakers get triggered after a 6.5% intraday fall. And you can see that the way that played out in the VIX. So the VIX yesterday had its biggest ever one-day decline. It dropped 36%. Today, it rose 21%. But if you look at where the VIX was at the highs, it was pretty close to the highs of the last 2 days. So the market certainly had a bit of a conniption intraday. Now, there are a couple of reasons for this excessive volatility that we've seen. One, of course, is being influenced by huge options volumes that are going through. Now, last Friday, that was this day back here, which was a big down day. The market was down 6% that day, saw the biggest options volume in US exchange history with more than 100 million contracts trading hands. Now, that is a staggering volume of options if you consider that the pre-COVID market generally traded about 1/5 that many on any given day. So it was like a five-fold increase on the pre-COVID daily average. Now, with the rise in options trading comes leverage, because obviously options are designed specifically to provide leverage to the buyers. Even if those options are very short-term, i.e. the same as zero DTE contracts, they're still adding leverage that traditional vanilla equity trading doesn't add. Now, this boom in options trading doesn't only increase leverage, it multiplies the dimensions for which investors experience selling stress. You think about it, an options contract is more than a function of just price, all right, because they have expiration dates and they have fixed strikes. This additional profit and loss stress can create forced buyers and sellers that can emerge throughout a trading day, which can really exacerbate those intraday swings. Now, the wild swings that we're seeing in the market, both intraday and day-to-day, are evidence that the market is not trading on any sort of fundamentals. It is not really trading on anything other than mechanical pain. And the massive boom we've seen in options trading is a huge factor in that. Right, so, 3.5% decline today really and truly should be expected after the 9.5% gain we had yesterday. A couple of things I don't love right at the moment is HYG. This is not signaling healthy credit markets. HYG is at 13-month lows. That's no bueno. And also the continued pummeling of the bond market. TLT, which is a good benchmark for how bonds are trading, was down another 2.76%. And that saw US 10-year yields rise again. They're now back up at 4.43%. That's interesting. You look at bonds, they're kind of signaling a stagflationary kind of environment. If you look at gold, gold hit a new all-time, or virtually a new all-time high today. We're very, very close. That's kind of signaling a bit of an inflationary outlook. If you look at something like oil, that is very deflationary. Oil prices collapsed. And you could say the same about copper. Okay, it bounced a bit today, but you've got bonds, gold, kind of signaling inflation/stagflation. Oil, copper, very clearly signaling it deflation. Which is another way of saying markets really don't have a good read on this at the moment. That's what I got for you today, folks. I hope it helps, and I'll catch you tomorrow. Thank you.